So welcome class. This is a CPA foundation level, CFA foundation level financial accounting paper that was done in December 2021. So CPA foundation level or CFA foundation level financial accounting paper that was done in December 2021, and we are going to handle a question on cash flows. Cash flow statements, that's what we're going to handle. So question 3, that is the question that has the cash flow statements. So we'll go straight to the question, and we'll start with question 3A. The question reads, identify 4 books of original entry used in accounting. Identify 4 books of original entry used in accounting. So just that's a small hiccup there, but it's okay. Identify 4 books of original entry used in accounting. Now, books of original entry, these are the books that basically help capture the accounting information before it goes to any other book. And the question is asking for only 4, though we can have quite a number than 4. So I'll go straight to the books. We have the purchase day book, also called purchase journal. Then you also have the sales day book, also called the sales journal. We also have the purchase returns day book, also called the purchase returns journal, sorry. And then we have the sales returns day book, also called the sales returns journal. And these ones are also called the sales returns. You've sold, the goods come back, so they are called returns inwards journal. This is also another name for them. And the purchase returns is also called the returns outwards journal. Then you also have the general ledger. The general ledger is also part of the books of original entry. And you also have the petty cash book as one of the original books of entry. And we also have just the cash book, petty cash book, all of them. These are books of original entry. The accounting information is entered in them before it can finally be transferred to other books for further analysis. Now, the purchase day book or purchase journal, this one is used to record all purchases made on credit. When you sell goods when you buy goods from suppliers. On credit. So that brings the credit a kind of a relationship. When you buy goods from suppliers on credit, you enter that information in the purchase day book. And when you sell goods to customers on credit, you enter that information in the sales day book. These are sales made to customers on credit. And then purchase returns day book, that one records all the purchases that you've made from the suppliers. Then for one reason or the other, maybe they don't conform to the conditions or to your instructions, or the goods have been supplied in excess of what you requested. Then in that case, you might always return them back to the supplier, and you record that in the purchase returns day book. Sales return day book, when you sell goods to customers, then for one reason or the other, they return these goods back to your business. That's why it's called return inwards. They are returning them back to you. So that information should be captured in the sales returns day book. General ledger, this one records all the other transactions that cannot find a place in any of these other books of original entries that we've just mentioned. Any of these books of original entry. If a transaction can't find its place in this, then it will go to the general ledger, just as the name suggests. Then petty cash book. This one records all the minor expenditures in an organization, or the minor expenditures in an organization. It's very common for organization to have these small operational expenses here and there, and normally there's a petty cashier who is charged with that responsibility. So all the information of these minor expenditures will be charged to the petty cash book by the petty cashier. Then of course you have the cash book, which captures all the receipts and payments in an organization as per the as and when the transactions take place. So these are, just pick any 4 books from this, and you'll be good to go with this question. Let's look at question 3b. The following, sorry for that, the following are the summarized financial. I think I'll make use of information which I have here. The following are the summarized financial statements of Eneza Limited as at 31st October 2020 and 31st October 2021. So we have the sales, then cost of sales, gross profit. By the way, you can just download this thing from just underneath. There's a copy of this paper, so you can download it for easier revision or for easier of your workings. So sales minus cost of sales, we get gross profit less distribution and administrative expenses. We have 7,000 shillings, and then less interest received, less interest paid. Oh, add interest received, sorry, less interest paid. We have profit before tax of 6,000, less taxation. We have profit for the year 3,200. Then you have the statement of financial position. Now, don't get carried away here, by anxiety or something. Normally, when a question on cash flow statements will always have an income statement, which is what we've just gone through, and it will also have the bank, the statement of financial position, commonly referred to as the balance sheet, and the balance sheet or the statement of financial position will come in 2 years. So we always have the current year and then the preceding year. For a cash flow question, we'll always have the current year and the preceding year, and that is to enable comparisons to be able to come up with the movements in cash. After all, cash flow is all about the movement in cash. That's what we are trying to find out. So we'll be given 2020, like this one, we have 2020 and 2021, and then the statement of income or income statement will be for the current year, the year that you are talking about. So in this case, this statement is expected to be for 2021, and as you can see, it's 2021, and then we have the balance sheet for 2021 and 2020. So this is the preceding year, this is the current year. It's normal, and that is to allow for comparisons, as we are going to see when we continue that question. So of course we have the non-current assets, then we have the current assets, then we have the total assets. Total assets is current assets plus non-current assets. Then on the liability side, we have equity and liabilities. We have the equity, and then non-current liabilities, and then we have the current liabilities. To add all of them, you can see it's balancing at that 24,440 for this year, that is 2021, and 18,960 for the previous year of 2020. So let's go to additional information. The process of the sale of non-current investments amounted to 600,000. Now, remember, the zeros have been restricted in the question above, so please be very keen on these extra zeros. They may not be there. So the process of the sale of non-current assets amounted to 600. Equipment with an original cost of 1.7 and a net book value of 900 was sold for 640 during the year ended at 1st October 2020. Sorry, during the year ended at 1st October 2021. And then the following information relate to property, plant, and equipment. We have the year 2021 and the year 2020. The cost less accumulated depreciation. Please just make sure you download this paper, because I can see this one has a lot of errors, but that's how it's supposed to be. That's how it's supposed to be. Let me see if this one will agree. That's how it's supposed to be. So the cost less accumulated depreciation, you have the net book values. Then dividends totaling to 1.6 were paid during the year. Good. So what are you required to do? Statement of cash flows in accordance with the requirements of IAS 7. Statement of cash flows for the year ended at 1st October 2021. So that's the question. We need to come up with the statement of cash flow for the year ended at 1st October 2021. Let me just create some space for that. Okay, and I think we are good to go. The best way to point to start this question is normally with the additional information, and so we'll start from there. So, additional information: the process of the sale of non-current investment amounted to 600. Process of sale of non-current investment amounted to 600. So let's just go to non-current investment. Non-current investment, where do we have that? They are here. Non-current investment amounted to 600. So this asset was sold at 600. So that means there was a profit on sale of investments at 100, which is normally charged to the P&L account. So profit on sale, you see, it was valued at 500 in 2020, but in 2021 it was sold at 600. So it was sold at 100 shillings extra. So that is profit. We call it profit on sale of investment, 100 shillings. Let's just take note of that. There are we don't have much in that particular additional information. Then equipment with an original cost of 1.7 and a net book value of 900,000, okay, was sold for 640,000 during the year ended that. So this one has some working. So we'll simply say equipment. We'll open an equipment account here. Equipment account. So this is credit, and then we have debit. Let me see again. Equipment with an original cost of 1.7 and a net book value of 900 was sold for 640. In fact, there's no need for us opening this one. It's quite a straightforward thing. This is a straightforward thing, so there's no need of us even going that direction that we're going. So equipment with an original cost of 1.7 and a net book value of 900,000 was sold. So we can simply say if the original cost was 1.7, net book value 900, we can simply say that the accumulated depreciation is equals to 1.7 minus 900, which gives us 800,000. I'm ignoring the zeros. So accumulated depreciation, this was the original value, this was the net book value. The net book value 900 was sold for 640. So this is the accumulated depreciation. Accumulated depreciation is 800. It was bought at 1.7. It depreciated by 800. At the end of its time, it was valued at 900,000. So that's the whole thing. But then it was sold for 640. Sold at 640 instead of 900, because 900 was its net book value as at that particular time. So this means that it was sold at a loss. Sold at a loss of 900, which is its value as at that particular time, minus the value at which it was sold at, which is 640. So this gives us 260. So this is loss on sale of equipment. So we are done with number 2. Accumulated depreciation is 1.7 minus its book value at that particular time, 900. So balance is 800. And then it was sold at 640 instead of 900, which we've been told was its net book value. So it means it was sold at a loss of 900 minus 640, which is 260. So 260 becomes loss on sale of equipment. keep that information. We will use it later. Okay. And I think we are done with number 2. So let's go to number 3. The whole thing is about understanding, that is. Number 3. Additional information number 3. The following information relate to property, plant, and equipment. Yeah. So cost is that. Accumulated depreciation is that. Okay. So when we are talking with about cash flow statements, there are some things that are they just come automatic, like depreciation. Depreciation is a very important issue in cash flow because normally in a normal profit and loss statement, we deduct depreciation. We show it as an, alongside other expenses and losses in the P&L. Expenses and losses, that's why we'll have depreciation. Part of the asset that has been used up in the generation of that year's income. But the truth is that this money doesn't go anywhere. There's no movement of cash. And cash flow is only about the movement of cash. So since this money doesn't move anywhere, we always return it back because it's always deducted. It always reduces the profits. So we return it back because it has not exchanged hands. It doesn't involve movement of cash. So it's always important that we calculate the depreciation. Now you see a question like this, that's definitely where they are going because they have given us accumulated depreciation, and of course they are not telling us anything other than that. And if we go back, you can see non-current asset. This is where we expected to see depreciation, but depreciation is not here. So depreciation is here in our additional information number 3. So it means we have to tackle depreciation and find out what is the depreciation at this particular level. So we'll open a depreciation account. Open a depreciation account, and then since depreciation is a liability, basically, yeah, to appear as a liability, we will so we'll have balance brought down of 5,800. That's the depreciation. It appears on the credit side, and then of course we are going to close the year with an accumulated depreciation of 6,800. So this will be balance carried down. When you close the year, we talk of balance carried down, so that the following year we start with this balance on the credit side. So balance carried down 6,800. It's very good to understand these things. But even if you don't understand, please, 2020, the preceding year, credit. The succeeding year, debit. As simple as that. This one is balance carried down. This one is balance brought down. As straightforward as that. Though you need to understand how you go about this. Then we are now going to calculate, because this year there was some depreciation. We know there's some depreciation here. Equipment with an original cost of 1.7 and a net book value of 900 was sold for 640. We've said that the depreciation for this particular equipment is 800. Assumption is that we have not included this in these figures, because this is at the end of the year. So let's just do the depreciation for this particular equipment here, and you can talk of that equipment. Actually, it will come from the disposal account, because we are going to open a disposal account. So we'll say disposal account. For that particular equipment that we've sold, the depreciation is 800. So we will, of course, credit the item with 800, and then we debit the depreciation account with 800. That's how we find ourselves here. So we'll credit the disposal account with 800 being depreciation, and then we come here and we debit now the depreciation account as a result of the disposal. So we have 800 like that. That is it. So we'll come here, get the total. This total will be 7,600. 7,600. And then the difference is it 2,400? No. The difference is 1,800, I suppose. Yeah, 76. So this will go to the statement of cash flow. Statement of cash flow. It will go as 1,800. So that is the depreciation that we'll be having for this particular year. So 1,800. Then the other thing we might also, if you see it like this, the other thing that comes into mind is whether the assets were acquired this year or not. Whether there was an acquisition, because acquisition of asset means that there was a cash outflow. When we buy an asset, money must have gone out of the business. So let's find out if there was any cash outflow through equipment acquisition. The way to go about this is very easy. We simply open a PPE account. Open a PPE account. These are now accounts that you may not even escape. You may not escape whenever you are dealing with a cash flow statement. So let's open a PPE account and let's see how we are starting our year. PPE account 76 2020. You can see 2020 there's no figure. 2021 there is 76. So let's see additional information. Actually the 76 is already here, so maybe all we need is here. So how much did we start with at the beginning of the year? 11,900. And because this is an asset is a debit account, so we'll come here and say balance brought down, and since it's an asset, 11,900, because assets are always a debit account unless otherwise, but they are debit accounts. So cost 11,900, and then of course this is will be the closing balance 14,400. So just to be on the safer side, we don't have to think so much about it. Balance carried down 14,400. Notice that I'm deliberately leaving space so that we can fill in some information that we find relevant, and especially for the PPE account we have the revaluation account, which you must also consider. So 14,400 will be our balance carried down. Just come right here, balance carried down 14,400. Then go and find out if we have any revaluation reserve, and it's already here, revaluation reserve. You can see it's on the liability side. So for the previous year 1820, we'll simply have it here, balance brought down. How much? 1820 on the credit side, and then again we'll have balance carried down. Now notice this is balance carried down because these are the closing figures at the end of 2020. We will be talking about revaluation reserve 2,000. So that the following year it starts with the balance on the credit side. So 2,000, like that. Then there was also something on disposal. There was an asset that was disposed. So we have to show that that asset has been disposed. There was an asset which was disposed, which has to be captured here. So when we dispose an asset, we simply credit because we are reducing the assets. So let's look at the equipment with an original cost of 1.7. So this is the figure that we're going to use. So that asset was disposed. We have to show that assets have reduced by that figure. So disposal account 1.7. Don't include the zeros because those zeros have been restricted. So having done that, normally that will be the end of this. Get the total. So at this juncture, I think I will need a calculator. Let me just see if I can get a calculator from here. So we can go together. Good. So calculator 1820 plus 1700 plus 14,400. That gives us 17,920. So 17,920, 17,920. So 17,920 minus 11,900 minus 2,000. This gives us 4020. So 4020, and we can simply say that this is the acquisition cost, or the bank showing that that was the money that actually this will be the bank. The bank will this shows that the bank lost 4020. Bank lost 4020, and that is what is of concern to us. So we can simply say bank account had to pay 4020. That is the cash flow that we are actually interested in. Okay, so then let's move to the next item. I think we are done with that. So let's look at the next item. Dividends totaling 1.6 were paid during the year. Yeah, dividends totaling 1.6 were paid during the year. Now that we've been given, that is straightforward. But the other way of working out dividends, if you had not been given, is simply come here, retained earnings, check this, 3.6, that is at the close of the previous year, plus 5.2, that gives you 8.8 minus the profit and loss for the year, 3.2. Profit for the year, sorry, it is 3.6 plus 3.2. I think we need to draw that 3.6 plus a ledger, but it's 3.6 plus 3.2 minus 5.2. 3.6 plus 3.2 minus 5.2. This will give you 6.8 minus 5.2, which gives you 1.6. So that's how to go about it. But you can open a ledger just to be to get it right. You can open a ledger to get it right. That is, if you will not, if the question will not have given us that figure, we'll simply have where is it? 3.6 plus 3.2, of course. That is the balance here, P&L 3.2, and then we'll have 5.2 as the balance carried down. 5.2 as the balance carried down. So this will give you the 1.6 as dividends. But this is if you will not have been given. That's how to go about it. But the question is has actually given us that figure, so we don't need to go there. Thank you. I think we are done. We are good to go. And unless if we find something else that might need attention. So let's go to the question. Now the question is, this is which company? Statement of cash flow. We are talking about, let me see the name of the company. This is Eneza Limited at 1st October 2021. Eneza Limited at 1st October 2021. So we'll come here and say Eneza Limited. Cash flow statement as at cash flow statement sorry, for the year ended at 1st October 2021. You can have 3 columns or 2 depending with how you like it. Can have 3 columns or 2. So then we start, and we always start with the cash flows from operating activities. Cash flows from operating activities. Now the cash flow statement will always have 3 sections: operating activities, investment activities, and financing activities. Just that. So we start with the first one, cash flow from operating activities. That is the format. So you don't have to change or bring investment first or no. Just work with the format, which is cash flow from operating activities first. And then cash flow from operating activities, you are going to start with profit before tax. Notice, please, we are working with profit before tax. Transactions are marked here, so make sure you at least try. Just do something. Like this one now, you can see this is just purely format. There's nothing here that can make life difficult for you. So profit before tax is here, 6,000. Just pick that figure as it is, profit before tax. And this one, push it to the farthest end. There's nothing really that we're going to have workings here. Then we add or subtract. Basically, we'll talk over non-cash items non-cash and non-operating items. Non-cash and non-operating items. Non-cash and non-operating items. So non-cash and non-operating items. Remember we said that cash flow is all about cash movements. So anything that doesn't involve cash movement, we are going to basically return it here if it had been deducted in the P&L account. So we'll be returning it here. And then there are some items which are not necessarily operating items. They have not been dealt with wrongly, but because they are not operating items, we may either remove them or add them. Depends, but in most cases we remove them and then we'll add them at their right classification. So non-cash items, the obvious one that we have for non-cash items is depreciation. Depreciation is an obvious non-cash. It doesn't involve movement of cash, so we simply come for depreciation. That is very obvious. Depreciation is in the additional information, so just get it. Actually it's here, statement of cash flow 1,800. So we simply come back here and say 1,800 like that, and then we go for the next one. Interest received, you can see. And for the operating items, in most cases, just check, especially the non-cash items and non-operating items, just check in the P&L account that will have been given. So interest received 500. Interest received is not an operating item. It is an investing item. So we are simply going to remove it, and then you can see we had added it, and it's true we need to add it under normally when we get gross profit we add incomes and gains. So we had added it, so we simply remove it and then we'll return it back in its rightful place, which is the investing activities. So we remove it from here, interest received. So we'll simply say interest received 500. We are removing it. When you remove it, you simply show it in brackets. That will already signify that you are doing away with it. So interest received 500 to show that you are removing it. Then we come back, interest paid. This is also, yeah, you can treat it as a for interest paid. Interest paid, you can treat it as an investing activities, or we simply bring it back later. So for now, we really don't have to include it here. It's not an operating item. It will come normally later. So let's because interest paid is treated as an, money goes out or an expense, treated as an expense, we simply return it back. We had deducted, so we return it back. How do we return it back? By adding it back. It had been deducted from our profit, so we return it back. The reason is that it's not an operating item per se and shouldn't come at this particular point in time. So we simply come here and say interest paid. So interest paid 1,500. Interest paid 1,500. Then we go back. Let's go back. Yeah, I think now we are done with that. So the next thing is if we have any profit or loss, they are also captured in the P&L, because normally after the gross profit we add profit, and then profit on sale of profit of, generally we add gains and incomes, and then we less losses and expenses. So that's where we are. So you can see there's a profit on sale of investment. Did we really realize this profit? Yeah, that's the question. But again, what is very important is that we realize 600 shillings, and that 600 we are going to realize under investment activities, not under operating activity, because this is not an operating activity. It's an asset. You can see it's under non-current assets. So it's not an operating activity. We are going to consider the 600 that we received, but under investing activities. And we actually received 600. So we'll do away with the 100, which we had already shown as a profit on sale of the asset. So we do away with it. We had added to the profit. So we are going to deduct it to reduce the profit by the 100. So we'll simply say profit on sale of investment. Profit on sale of investment. How much? 100, which we had added to the profit. So we are going to less. And then of course we also have loss on sale of equipment, which, if I'm not wrong, was valued at 260. Now this one loss we had deducted, because we normally add incomes and gains less expenses and losses in the P&L account. So because we had deducted, we simply return it back. That means we are going to add it back, and just put the 260 without the brackets. That will mean that you have added it back. So that's how it will be. Let's get our calculator. So this will be 1800 minus 500 plus 15 minus 100 plus 260. That gives us 2960. So we'll have 2960 here. 2960 have as non-cash and non-operating items. So once you are done with that, we go to the second stage, still under operating activities, and we talk of operating activities. Operating cash flows. Before working capital, from working capital changes, changes in working capital, or operating cash flows from changes in working capital. So this is where now the comparison will come in when we talk about the current year and the preceding year. And normally the items that are in question here, that are in focus, are normally the inventories, the accounts receivable, and inventories, accounts receivable for the assets, and then of course short-term investments and cash in hand. These ones are treated as cash and cash equivalents, and they're the basis of the cash flow statement. And then we also have the accounts payable. Accounts payable is also put under sharp focus here on changes in working capital. Bank overdraft, this is part of the cash and cash equivalent because it's a short-term loan. Okay, so let's work with those three. We can already see that only three. Taxation here. Accounts payable, inventory, and accounts receivable. Those are the items that we are going to tackle here. So let's look at the changes. Like inventory, there's a change of from 2040 to 3000. This is a change of how much? 960. A change of 960. Now when inventories increase by 960, what does that mean? That we spent an amount equivalent to the increase in inventory, which means that we spent 960. That means that that was an outflow. Money went out of the business. So we simply come here and say that an increase in inventory, 960, and this is an outflow. The 960 in brackets shows it's an outflow. Money left the organization. Then we come to the accounts receivable. Now just take we started there with 6,000, or the previous year 6,300. Now it's 7,800. There's an increase of 1,500. Again, that increase simply shows that we spent. These are debtors. They have our money outside there. They have our monies outside there. So it's as good as saying that it's as like we spent. because they are holding our money outside there. So that means we have 1.5, an increase in accounts receivable 1.5, and this is our money which is outside. So we'll simply put it as brackets, increase in accounts receivable. And it's very simple. If you can't understand this thing, just know increase in current assets. Increase in current assets, and we are looking at previous year and this year. If there's an increase, then you simply less, you deduct. If there's a decrease, it's the opposite, you add. Just that. Then let's look at the treatment for the liabilities, current liability, accounts payable. Accounts payable, there's an increase also from 2380 to 2540. This is an increase of, just take 2540 minus 2380. That is 120 plus 40, 160. So there's an increase of 160. What does this mean? That accounts payable, remember, we are the ones who are supposed to be paying the suppliers, but we have not paid. We are holding their cash. So it's like an inflow. It's like, for example, we can take it like a loan. A loan, when we receive, when our loan increases, it simply means that we have received some money. So it's the same thing here. Our accounts payable has increased, which means that we are holding on to their money. We are holding on to their money. So it's like an increment, a cash inflow to us. So we'll simply come here and say 160, an increase in accounts payable, 160. But since we are treating it like an inflow, we didn't have that money, but now we have it courtesy of the creditors. So we treat it as an inflow. Now notice increase in liabilities, positive. Increase in current assets, negative, and the opposite is true. So that is, if you can't understand, just master this as the last option. Then, of course, this will mark the end of that part. So we'll get the totals. The totals here will be, just make use of a calculator here. Let's start with the positive. So 160 minus 1500 minus 960. That gives us 2300 negative. That's how we go about it. Then now we go to the last bit, which is now this will give us the operating cash flows before interest and tax. Operating cash flows before interest and tax. Operating cash flow before interest and tax. Let's add this. We get what we call 660. That is the operating cash flow before interest and tax. Operating cash flow before. This is now part of the format. Operating cash flow before interest and tax is 2960 minus this. We get 660. It's actually plus, but you can see these are negative. Then we now less, at this point, you can now less the interest that was paid. Remember, we said that it was not just at the right place. So we are now using the format to put it in its rightful place. So interest paid, though it can also still come under investment activities. So interest paid is 1.5. We had basically returned it. Now let's less it, because at the end of the day it involves money flowing out of the organization. And then you also have taxes. Remember, this is operating cash flow before interest and tax. So interest, taxes, so that we get the net operating cash flows. So taxes, wow. Now taxes, there's always a way to compute taxes. Tax paid. Let's just work it out here. Tax paid, we've not worked that one out, but we'll work it here. So tax paid, this is how tax paid account. Open a tax paid account, credit, debit, tax, you can see. So it will be on the credit side. Balance brought down, how much? 2,200. And then this one at the end of the year will have balance carried down 2,400. Then go to the P&L. P&L, this will be on the debit side. So P&L taxation 2,800. Taxation 2,800. So we'll have it as P&L for taxation. This is 2,800. Yeah, we just pick it here. Sorry, taxation 2,800. Pick it here. We credit the tax paid account. So this will give us 5,000. I think 5,000. This will also be 5,000 as a balancing figure. The difference is 2,600. This becomes our statement of cash flow. The 2,600 is sent to the statement of cash flow. So just come to the statement of cash flow here. 2,600. And all these are now, in fact, the best thing we can do is to put them here. 1,500 and 2,600, sorry for that. So that now we have those figures. We are deducting all this. This is 4,100 in brackets. With less, we get the net cash flow here. So that will give us 660 minus 4,100. That gives us 3440. 3440, I believe. Yeah, 3440 negative. In the last column, yeah, 3440 negative. So that is the column that we are talking about. Let me just get it right. 3440. So we are on the right track. 3440. We are on the right track so far. Yeah, we are on the right track so far. So 6,000, 3440. Now we go to the next stage, which is now we are done with the cash flow from operating activities. You can see that is the figure that we come up with here. So this will give us, let's deduct from that so that we finish this part completely. 6,000 minus that, what do we have? That is 2560. 2560. Good. So you can call that the net operating cash flows. Net operating cash flows. So we are done with the net operating cash flows. So we go to the next stage, which is now the investing cash flows. Investing cash flows. Investing cash flows. That is the second stage. The first stage was cash flow from operating activities. Now cash flow from investing activities. Or rather, just for the sake of uniformity, we can talk of cash flow from operating activities. Cash flow from operating activities. Like that. Good. So cash flow from operating activities, what we are going to have is come back here. Now, of course, we'll start with the first one, which was the interest which we had received. Interest received. Yeah, interest received 500. So remember we received, so it's an inflow. Interest received. So we are just putting it in its rightful place. We had deducted it before. So interest received 500. Then we go to the next one. The next one, this is anything to do with investments. So most of them will come from here. The process of sale of non-current assets amounted to 600. So we sold non-current investment 600. So we'll capture that one. Sales proceeds of non-current investment. How much? The total amount 600. Remember the 100 we did away with. So we are going to capture the total amount of 600 here. Just capture the whole amount, how much we are interested in the cash movement. Then equipment with an original amount of 1.7 and a net book value was sold for 640. So the proceeds, what we actually received was 640. So we'll capture it as it is. Remember, this issue of losses we've already done with them. So capture as it was. The amount that was received is 640. So we'll say sell proceeds from equipment. Proceeds from sale of equipment. Proceeds from sale of equipment, 640. Then we'll also have what? We'll have there's something here still on the, yeah, I think we agreed that we had bought acquisition, we acquired the assets. When you acquire assets, money goes out. When you sell assets, money comes in. That's why we are picking them as positives. But we have now acquired assets worth how much? 4,020. So that means money left the organization. So we'll say acquisition of assets. Acquisition of assets, 4020. Money left the organization, so 4020 like that. And then is there anything else? So for the investment, to be sure, just go to the assets, because that's where the investments are. 76, we've already captured this. Intangible assets, investments. There's something here. For investment, we've already captured, we've shown this 600. But for the intangible assets, look, we started with 4,000, but now 5,000. It means we must have the value of intangible assets is now 5,000. But initially it was 4,000. It means that we must have purchased additional intangible assets worth 1,000. So, because the value has increased by 1,000, so it means we must have purchased. And if we purchase, it means money went out. So if money went out, that is a cash outflow. So you simply come here and say additional intangible asset. How much? 1,000. And this money went out. So then I think we are done. This is 500 plus 600, that is 111, plus 640, that is 1740. So back to our calculator. So 1740 minus 4020 minus 1000. That gives us 3280. So 3280. And it's negative, so like that. That is from the operating activity. So we go to the last bit, which is cash flow from financing activities. Sorry, I've seen this somewhere we missed. This is not cash flow from operating activities. It's cash flow from investing activities. Investing activities. Those are the challenges we go through when we teach in an online class. You know, online. If it was a physical class, possibly somebody will have corrected that. But it's okay. Cash flow from investing activities. We started with operating activities. Then we go to investing activities, and lastly, cash flow from financing activities. So, financing part of it, here we don't have much. We simply go to the finance section, and for finance now, finance, where are we? Long-term loan and current, long-term current liabilities. So finance, you expect to get most of the stuff here. So we'll start from here, share capital, and you can already see there's an increase in share capital. When there's an increase in share capital, it means we received more money. So it was an inflow. So increase in share capital, 1,000. Increase in share capital, increase in issue, or we can talk of proceeds from issue of shares. Proceeds from issue of shares. We talk of 1,000. means we issued, so money came in. And then go back to the same place, share premium. You can see share premium has also increased by how much? 200, from 3,000 to 3,200. So we'll also talk of share premium, 200, increase in share premium, 200. That means that we are receiving money from share premium. How much? 200. Good. Then we go to the third item. The valuation we are done with that. Retained earnings, that one will be captured under the dividends, so we don't have to go there. Long-term loan. Yeah, long-term loan is also a financing activity. And we can see it has increased from 1,000 to 3,400. That means that we have received 2,400 more. So increase in long-term loan. Increase in long-term loan, 2,400. Good. We are moving. We are in the right direction. Then let's see if we have any other thing. Yeah, there's nothing else. So there's also dividends. Dividends has to be captured under the financing. So we capture dividends. Dividend totaling 1.6 were paid during the year. So we simply come here and say that dividends, remember they were paid, dividends paid. So this is an outflow. So 1,600, we get rid of it. So this is 1,236, 36 minus 1,6, that is 2,000 positive. So let's add now all these three and we'll have our answer with us here. So 2560 plus 3280 minus 2000, sorry, 2560, sorry. So this is 2560 minus 2560 minus 3280, because that's a negative, and after 280 plus 2000, that gives us 1280, and the 1280 is positive. So 1280, which is positive. Good. So 1280, which is positive, and that 1280 now is the net cash and cash equivalents for the year. Net cash and cash equivalent for the year. Remember, we've added the three parts: the financing activities, the investing activities, and the operating activities, which we said that they are the components, they are the items that make up a cash flow statement. So cash flow is this, cash flow from operating this, from investment this, and from financing that. The net cash and cash equivalent for the year is 1280. Now, this 1280, we are going to add cash and cash equivalent brought forward, cash and cash equivalent brought forward. That is what we started with at the beginning of the year. What did we start with at the beginning of the year? We go to cash and cash equivalent. We started with short-term investment, there's nothing. Cash in bank, there's nothing. Cash in hand, 20. All these make up the cash and cash equivalent. The short-term investment and the cash in hand plus cash at bank, they make up the cash and cash equivalent. So we normally take short-term investment plus cash in hand plus cash at bank. In this case, we only have 20, which is cash in hand. And then we check if we have bank overdrafts, because bank overdrafts are also treated as just short loans. They are cash, so they are supposed to be paid within a short period of time. So we check if we have bank overdraft, and wow, there we have. So our assets were only 20 plus an overdraft of 1960. What does this give us? This it means we are operating in an overdraft of 1940. So that's the figure that we'll have here. At the beginning of the year, we started with 1940 negative. What will that give us? This will give us, that's what we started with, 1280 minus 1940. That gives us 660. So you might just want to check if this is actually the figure that we have at the close at the end of the year. If that is not the figure we have at the close of the year, then it means we are wrong somewhere, because the movement is this. What you started with is this, and what you are closing up with is this. It's as simple as that. This is the movement in the cash. This is what you started with. This is what we close with. So let's confirm if indeed this is what we close with. We simply come back here and do the same exercise that we had done to find the opening balance. So it will be this 1,000 short-term investment plus 40, that gives us 1040, minus the overdraft. Bank overdraft is 1,700 minus 1,700. What does that give us? It gives us the 660 overdraft. So it means we are correct. It's a very nice question because you can actually check whether you are passed or not just by yourself. So that means that we are 100% correct, and that's how you go about doing that question. So we are done. It's a very simple question. In fact, once you know the trick, how it goes, almost all questions on cash flows will just be like this. Questions on cash flows are actually a booster, and we mark entries. So just try your best. Just try your best. There are a lot of marks here. A lot of marks is hidden here just for free. Thank you. Let's meet in the next question.